Hello and welcome. My name is Jordan Selleck, CEO and co-founder of 51 Labs. 51 Labs is a digital marketing firm, events production company, and BD firm focused on the M&A market and VC communities. A little bit on my background. I did 6 years of investment banking. My wife is our co-founder. She did 7 years of M&A and corporate securities law. We have a 5-person full-time team. I just want to kind of run you through a little bit of our client base. You can kind of get a sense of the firms that we work with. So, for example, Middle Ground Capital, HKW, Eaton Partners, Steward Asset Management with Sheryl here on the call, and also Bassett Creek Capital with Rob, which is an example of some of the independent sponsor work that we do. I won't go into some of the videos and LinkedIn posts that we do. Happy to sidebar on that. But some of the facts and figures I do want to highlight are that we are the #1 content creator on LinkedIn in the lower middle market. I've been at this for coming up on 6 years, and the #1 video creator on LinkedIn in the lower middle market. So reach out to us if you have any questions about how you can market differently in today's environment. I kind of have a thesis that we're at BD and private equity version 3.0 in marketing. So next, over to the slide on our team. We have a five-person full-time team. If we're doing video shoots, for example, we did one with 6 portfolio companies in 6 different states in 30 days. And we had our team, but also our network of freelance videographers. So moving on, what I really want to highlight here is 51 Vets. Before we get into the agenda, for the past 4 years, I've spent a lot of time working with transitioning veterans, primarily from the special operations and fighter pilot communities. Worked with over 200 people to get jobs. And the way that you can help is to perhaps be a fireside chat guest, do lunch and learns over Zoom, where they speak about lessons from leadership to your firm, can do just info interviews with them, or provide internships and jobs. So the person I'd like to highlight today is Mike Luray. He spent 20 years in the SEAL teams, and he is looking for mid to senior level positions in corp dev, strategy, M&A and integration, project management, or operations in software. I'll drop, Nicole, if you wouldn't mind dropping his LinkedIn profile into the chat feature. And the attendees, please feel free to reach out to him, connect with him. He's one of many amazing transition veterans that we work with. Next, what I'd like to do is provide a little bit of background of today's event. So Rob Bauer, who's on the panel today, is one of our clients with Bassett Creek Capital. And we were down actually at a shoot in Atlanta for one of his portfolio companies and just kind of talking about the future. And he was just kind of joking, like, I'm just trying to get deals done right now. And it really kind of made us start to think about this unique position for the Fundless sponsors and the independent sponsors out there who are trying to decide, what do I do now? What do I do next year or the following years? How do I plan for that? So that was really the genesis of this event, and thinking through the pros and cons of, fundless or funded, which route is best. So the other questions and topics that we'll be running through today are, first, what is the first deal that Rob did? How did he get it across the finish line? Now he's up to 5 portfolio companies. How did he find a quality capital partner? Next, funded or not to be funded? That is the question, and that will be a robust discussion, I am assuming. Then anchor investors with Sheryl Mejía, who started Steward Asset Management, and they specifically look at being an anchor investor in emerging managers. And then talking about early mistakes and lessons from Fund 1, and Barry Uphoff from Martis Capital will be leading that. So if we can go on to the panelists, I'd like to first have Rob come on to the panel and give a quick introduction.
Good afternoon, everyone, and Jordan and 51 Labs, thanks for organizing this panel. My name is Rob Bauer. I'm managing member of Bassett Creek Capital. I've been doing private equity investing for a little over 20 years. 5 years ago, I started Bassett Creek Capital, an independent sponsor firm. The foundation of the firm is partnership. We want to create a culture of teaching and learning from one another. And as Jordan mentioned, I've done 5 acquisitions in the last 3 years, and currently am chairman of Bassett Creek Services.
Alrighty. Is it fair to say, Rob, that you've done more M&A deals in restoration and renovation than others?
Yes. As many people could attest to, I'm not a great handyman, but I've done about 30 M&A deals in the restoration and renovation space. And it's an industry I know, an industry I love, and I have a lot of great friends in the industry.
Awesome. All right. Next on deck, Mr. John Finger.
Hi, John Finger, partner with McGuireWoods in Dallas. My practice consists of representing emerging private equity managers, other committed private equity funds, as well as independent sponsors. We have the leading independent sponsor-focused practice for law firms, as well as host the largest conference for independent sponsor-led transactions, which takes place in Dallas and will be in October again after a year off. And really excited to be part of this great panel.
All right, Peter.
Hi, everybody. My name is Peter Roushdy. I'm a managing director with Gladstone Investment. I've been with the firm for 10 years. What Gladstone Investment is, it's a one-stop buyout fund where we provide all the capital needed to close a deal between the debt and equity capital. We're also a publicly traded fund, so our fund is evergreen, which gives us a structure that's flexible in both terms of capital as well as the timeline. Roughly a third of our deals we do are with independent sponsors, and over the last decade, we've done approximately 15 independent sponsor transactions.
Cheryl.
Hi, Sheryl Mejía, managing partner, Steward Asset Management. Steward is an anchor investor to newly forming private equity firms. We're often a catalyst to the first close, and our institutional investors truly look to us to extend their reach into smaller and newer fund teams.
And Barry, last intro for you.
Yeah, thanks, Jordan. Good morning. Barry Uphoff, founder and managing partner of Martis Capital. We're a healthcare-focused middle market fund, healthcare services, healthcare IT, and consumer-oriented investments. We're investing out of our third dedicated fund, which was just under $600 million. In total, we've invested about $1.2 billion over 3 funds. We had a start from a family office that was, in a sense, we kind of function as an independent sponsor of sorts way back before our first fund. And then along the way, we have helped a handful and backed a handful of independent sponsors as they've done transactions and helped to get them started. So thank you for having me here today.
All right. Let's kick off with Rob. If you wouldn't mind just kind of walking us through the first deal that you did and just that process of getting the business off the ground, because it's so hard, number one, to find the first deal, then to do the first deal. And I think it could be really helpful to kind of share your experience. And then that'll lead into, how you met Peter and the Gladstone team. And as a reminder to all, we want this to be interactive and fun. So feel free to jump in, interrupt each other, and have it interactive. And to the attendees here, please drop your questions. If we can't get to them, we'll do a part 2 of this. But Rob, over to you.
Thanks, Jordan. When I think about my journey as an independent sponsor about 5 years ago, when I started Bassett Creek Capital, I was like, oh, I have my own investment firm, but I had to figure out how to get an email address. I had to figure out how to get a website, and not only do those basic things, but also find, source, come up with investment ideas. So, I really feel that I am an entrepreneur. So prior to starting Bassett Creek, I had done about 40 deals, had worked at 3 successful firms, and kind of developed my own investment strategy. So I was looking at a bunch of deals. I tend to take a industry-focused approach, investment thesis focused on industries. I did have experience in the restoration industry, prior to Bassett Creek. And about a year after starting the firm, I came across a phenomenal opportunity in the restoration space. And based on my prior experience, I knew I was going to have some headwinds because private equity in the restoration industry, they had mixed success. So I spent a lot of time, putting together a plan in quite detail about what a national restoration company should look like. And kind of going back to, the foundation of Bassett Creek, it's partnership. And so everything I was doing was about, hey, what partners do I need? Both in terms of finding the deals, running the deals, but also in terms of capital partners. I'm the only member at Bassett Creek, and I was looking for someone that not only had capital, but could also take the investment thesis, the plan to the next level. And a couple of weeks after I got the company under LOI, I met Peter Roushdy in Gladstone, and once we got to talking, I thought I had a good plan, but Peter really improved the plan, enhanced the plan, and we decided to partner up. And 3 years later, after just a lot of hard work and detailed planning, all of our hard work is paying off.
Before we jump over to Peter, random question: how many months did you go without a paycheck as an independent sponsor?
About 20 months, I think. So you have to, I tell all independent sponsors, you can't do this part-time. I mean, you got to dedicate, your life to it. And so, but you're right. I went almost 2 years without a paycheck.
All right, Peter.
Yeah, and when we met Rob, it really fit the three criteria I hold myself to about any partnership with an independent sponsor. It does come down to these three things every time. First is providing lightly marketed or proprietary deals. We do a fairly good job of sourcing deals from bankers, brokers, et cetera. And so bringing a broadly marketed deal isn't very valuable to us at the end of the day. And especially now with how high valuations are, every marketed deal is probably overvalued, and even more so when you're splitting economics with an independent sponsor. So we really look for independent sponsors that have either a unique sourcing method or a proprietary channel that they're sourcing transactions with, which Rob had. He had found a deal that, frankly, a lot of restoration companies didn't even know about. And to his credit, he found a diamond in the rough and got it at a great value. The second thing is having an angle. There needs to be a story, and it's not just about the company and where to take it. It's also about what value is being brought to the table by all the parties. From an independent sponsor perspective, are you bringing proprietary add-ons for a roll-up strategy? Do you have operational expertise in an industry, whatever the case may be? But I'm always looking for what everybody's bringing to the table. And a lot of that is inevitably because we're charging these companies management fees, and the management team eventually is going to ask, what are you guys doing to earn this? And I always feel like we need to be bringing value to the table to justify that fee. And then the third is fit. And this is my life's too short rule. There's plenty of deals out there, plenty of them you can get done. And I only want to do them with people I want to work with. So it's eminently critical to me that, we focus on fit early on. And with Rob, it was a great fit from the beginning. He came to the Gladstone offices. We met for a full day, and it seemed like it was going to be a great fit, and it has been. And going back to the angle piece, Rob clearly had an angle. As you guys noted, he's done more deals in the space than anyone, has been involved in a roll-up strategy previously, and knew how to make it a better process for Bassett Creek. So, my kind of summary is, I'd always come up with make sure when you're going to capital partners and figuring out where to go, make sure you're checking the boxes on those pieces and make sure you're hitting the mark.
John and Peter, I'm curious to hear kind of your thoughts. What percentage, if you had to make a generalization, of independent sponsors that you've worked with or spoken with, do you think have a very specific strategy like Rob?
Peter, I'll throw it out first. I mean, honestly, probably 10 to 15% would be my estimate. It's pretty small, but it's not crazy small.
Yeah, I'd agree with that. I mean, the reality is most independent sponsors have been at other private equity funds or in investment banking. So at that point, most of those groups are not, they're generalists, or they have more broader focuses. Perhaps a lot of the independent sponsors I've seen coming from the consulting side perhaps are more specialized, but that's fewer and further between.
Do you think that the case to go to specialize either in one industry or in a few is worth the trade-off early?
I think it has its pros and cons, and I think Rob can opine, it definitely makes sourcing harder when you're limiting yourself to a very narrow swath of companies. I think it can be challenging to get your first one done, but it probably makes the likelihood that you can get that first one closed a lot higher. So it is a trade-off for sure. But you also don't want to put yourself in a position where you're specializing when that might not be the strongest suit of your independent sponsor firm. I think it's about finding your niche, and industry is not the only niche that can be filled.
Oh, sorry, if I could just comment on that one. In the early days when I was getting started with Capricorn as sort of our sponsor, the original intent was to focus on healthcare. But my background from a credit-oriented hedge fund and Silver Point Capital was such that this was 2007. I literally joined working with Capricorn, if you will, in May of 2007, right before the financial crisis. So while the plan was to focus on healthcare transactions, the opportunity of a lifetime came if you had dry powder on the debt side with the financial crisis. So we hit that really hard. That investment seemed really hard. It was just an unprecedented time. I mean, we were even buying secondary opportunities off of hedge funds and making great money. It's, when a family office, which Capricorn is making money off hedge funds, which it was at the time, is a pretty unique day. And then ultimately, as that opportunity went away, circa 2009, 2010, then we pivoted to the focus on healthcare. So I think that sometimes you have to take what the opportunity, what the market gives you, and in that particular time, it gave an incredible debt opportunity for a broad focus.
But it's interesting because you did have a focus in healthcare, so you had the domain expertise within that industry. And I think that's one of the interesting things I've observed with Rob, your path and our discussions about that is that everyone in the industry, and there's the trade-off of having to focus on the industry, but so many people, the operators, the investors, the advisors, that there's a lot of concentration within that network. John, maybe to kind of shift over a little bit, curious to hear, what are some of the big considerations on staying fundless or going funded? And, just what have you observed in the hundreds of independent sponsors you've spoken with, the pros and cons? And then let's just kind of kick it off from there, because I know in our prep call yesterday, it was basically turned into the event because it was. So John, we'll kick it off to you.
Yeah, no, I guess I'd throw a few things there. One, kind of echoing what Peter was talking about. It is, in my estimation, it's all about the fit, and it's all about finding the right partner for your opportunity. And just to step back 1 second, I think what has made and was a big part of the reason why the marriage was so successful quickly is both Rob and Peter knew what their area of responsibility primarily was supposed to be, and stayed true to that. And really, there was a healthy ego check at the door, which I think is critical, right? I mean, both of them had an incredible working relationship from the very early days. And I think that is so critically important, which, kind of segues to your question, Jordan. I think one of the reasons why so many of our independent sponsor relationships want to remain fundless is because it does allow them for each opportunity to bring the right capital partner to the situation. Maybe the next one isn't Peter, and maybe it is, but having that flexibility is a huge consideration. Certainly, raising a fund, having that dry powder ready to go, being able to credibly talk about your $500 million fund, that's all great and obviously can be impactful. But there clearly remains so much benefit to being fundless. And so I'd also throw out, of course, it is the opportunity to potentially pursue situations that, maybe don't fit squarely within your fund mandate. So obviously a lot of considerations. It's something that with so much dry powder out there, both for the independent sponsor-led deal, but for also a committed fund, I don't think there's any right answer necessarily. I just think everyone is struggling with the right answer for them. So maybe I'll open it up for the rest of the panel to weigh in as well.
Maybe I'll jump in there, John. Good points, because we actually spend a lot of time talking to Fundless teams, trying to convince them not to go to the fund route to make sure it's a good test. Going the funded route's a lot of work, and so and many years of dedication, and so you can often have a very good life and get paid by deal by deal. If you have a good pathway to, with committed capital partners, and you have expertise that will make you an attractive business partner to your targets. And so if you have those two parts of the equation, often staying independent is often very advantageous. If you are reaching into deals that are more competitive, that's where we see teams need the committed capital pool.
Yeah, and one thing that we discussed earlier was just how the independent sponsor market has changed. I mean, we've been dealing with independent sponsors over 10 years now, and terms have changed. Reception by the banker community has changed. I'm sure when we get to the Q&A, we're going to talk a little bit about how that market has changed a bit, but now it's not a disadvantage, whereas 5 years ago it probably was from getting a deal signed up, getting it under LOI. And I don't think that's the case any longer. And as there might be some additional pressure on 2 and 20 on the fund side, there's an opportunity to get deal by deal economics. And in a lot of cases, what we're seeing are you can get actually better than 2 and 20 based on higher return thresholds with a capital partner like Gladstone or with someone else. So, and without having any negative deals impact you across your portfolio, that's a pretty attractive dynamic at some level that's hard to pass up.
I will say though, during 2020, many independent sponsors found their capital partners sort of rolling up the carpet and saying, okay, we're not going to do much more right now. And so if you had a committed fund during that time, it would have been very advantageous to scoop up some great value.
Yeah, I do think that is a downside, Sheryl. I think you're right. Again, going back to the financial crisis, which seems eternities ago, but that was a time period. If you didn't have a good partner or dedicated capital, it was hard to round it up to get transactions closed. I know times have changed since then, but I think you're right. I think 2020 presented a little bit of a blip, and things are great now. But that is a caution, at least on the independent sponsor route.
I will caveat that with saying that getting that broad capital base of partners, limited partners into a dedicated vehicle is, often 300 plus meetings for, 10 to 20 commitments. So it's not, it's not a easy path, but it's, if you're prolific in your communications and you've got a good pace of deals that are, going to last for a number of fund vehicles, it can be an advantageous vehicle, which you'll celebrate by Fund 3, but in Fund 1 and Fund 2 have a lot of work ahead.
Yeah, Barry, I was going to ask you a question. How much of your time do you spend fundraising over a given year? And obviously not every year is the same, but could you give us a bit of an idea of what your time constraints are there? Yeah,
it's really decreased. If I look at the background and how we did it in Fund 1 with a large anchor investor signing up for half of the capital base, that made it easier, but it was still a good chunk of time. We did not use a placement agent in Fund 1 and 2. Now in Fund 3, in a way it was easier. If you deliver in Funds 1 and 2, then you have people who will step up and invest with you. But look, I would say on any given time, to answer your question directly, it's decreased from Funds 1 to 3, but it's still probably, it's sporadic, right? I mean, you can only really fundraise when you're in that period from a compliance standpoint and so forth. And then you hit it. Our philosophy is we hit it very hard for a period of probably 3 to 6 months, and we're wrapped up. And then on an ongoing basis, we're very focused on communicating with LPs and having those relationships. So if you do that along the way, I think it makes it a lot easier for the fundraise. And look, we do a lot of co-investments, and going back to days when we were raising things deal by deal, it felt like every deal could be almost like raising a fund. you know, you're going through this meetings and process and communicating on one deal. It could take a fair bit of time as well. It just depends on the market circumstance, the particular deal, and who you're chatting with.
Hey, Sheryl,
Mhm.
have you seen from your perspective a significant change and uptick in what I would call the hybrid model, right? Where it's not necessarily funded or fundless, but it's, you know, raising a, you know, smaller pool of committed capital, as Barry said. So much of these past however many years has been co-invest, co-invest, co-invest. A lot of what we're seeing are people interested in having a pool of capital, recognizing that may be likely half of what they're going to need on any given deal. What's been your experience?
Oh, yes. Co-invest is really the thing in Fund 1 and Fund 2 to really lock those investors, and they get a chance to see your deal prowess live. You know, it's really that relationship management in between fundraising. It's fabulously successful, and in fact, many institutional investors require you know, some amount of co-invest. So you know, with fund sizes, I think the smallest I would set out with is about 150 million. I think the most common thing we see, if you looked at the 50 you know, funds we've seen that are really credibly launching in the last year, you'd say probably the average fundraise size is 2 to 250, in that range. And you know, hopefully, especially what attracts an anchor investor like us and others, is that you're going to scale over time. So you're going to be a bigger footprint. We can be a bigger footprint with you, and institutional investors in turn can be a bigger footprint in your fund on the way to maybe 750. So it does require pacing, but you prove it out with the co-invest in Fund 1 and 2. So if you can do a $200 million fundraise, do you know, half as much in co-investment, at least half as much, if not equal amounts, and you can prove yourself on the way to a larger fund.
Yeah, Cheryl, that was spot on with our experience. Yeah, I mean, our first fund, the co-investments we had were almost as large as the fund itself, and it created a great avenue to the next fund.
Yeah, it's painful though if you end up doing a very small fund and you end up with a 90% co-invest, because some investors will insist on very fee-free co-invest. So that can be painful, and so we have seen some tendency, some acceptance of a very well-respected team getting some economics above 3x. It's going to be something you know, on the upside, to make sure that your small firm is getting their due just desserts for having had a very successful deal. But yeah, it's painful to give too much away from co-invest, because it's ultimately most LPs think of it as a fee break.
Right.
Rob, can you talk a little bit about, like, you know, where's your head at? You know, how many years are you into this? When was the first acquisition? First question is, how long did it take you when you went into the market to find a capital partner? How long did it take from beginning to, you know, signing with Gladstone?
Yeah, I mean, it's interesting listening to all the panelists. You know, my approach was, I'm going to go really deep. You know, if I do one deal a year, that's a success. And, you know, admittedly, that's a very narrow focus. You know, the types of deals that I look at, and, you know, I think maybe the Bassett Creek philosophy is, you know, let's really get deep expertise, you know, partner with operators, industry experts. Let's not look at 1,000 deals a year. Let's look at, hey, what can we do to improve the business organically, really, you know, bottoms up approach. And so I spent about, I mean, I came close on, like, you know, I want to say a dozen opportunities, but it took me about 1.5 years to get a deal under LOI. And then with, you know, all the detailed planning, I would say, you know, 4 to 5 weeks later, you know, Peter and I were in heavy diligence, you know, marching towards a close. So when I think about, like, funded versus fundless, you know, funded, there's, you have to do more deals, whereas, you know, the way I look at it as an independent sponsor, you know, I can do one deal a year, and that's phenomenal. Now it takes a lot of time to source those deals, and it takes a lot of time to just the energy to, you know, execute on the strategy.
Hey, Rob. Sorry, Jordan. Rob, I was just going to ask, tied into one of the questions, other than Peter's good looks and charm, I guess looking back at, that kind of analysis phase and finding the right capital partner, as I was talking to Jordan, I guess a couple of weeks ago, for me, with my relationships, I can't tell you how many times, I hear people say it just wasn't the right capital partner for this deal, whether it was, not kind of staying in your lane on certain things, not supporting the growth plan, just not the right fit. And it's so much of it's never a, gosh, I wish I got that extra 5 points of a carry. That just wasn't the right fit. But so thinking about it from your perspective, as you were going through that, what was important to you? Why did you ultimately settle on Peter? And what kind of advice would you have for other sponsors in that role?
Yeah, the way I think about it, John, is, I'm married now, but I'm also married to Peter as well. And, Gladstone, they're great because they're publicly traded. They're highly ethical. They provide both the debt and the equity. So, from a capital standpoint, we have no issue, but it really comes down to fit. I mentioned previously, I was facing a bunch of headwinds, and when I chatted with Peter, it's almost like he got it right away. And I remember when I was talking to a bunch of investors, I was taking a bunch of notes when Peter was describing himself and Gladstone, and I stopped taking notes after like 2 pages. I just put a star, and I was hoping he would be interested in the deal. So it's for what I was looking to do, Peter's almost the perfect partner. And you mentioned earlier, roles and responsibilities. That was very important. Peter and I had a lot of in-depth conversations about, hey, what are you going to do? What am I going to do? That's evolved a little bit over time, but it's hard to describe what fit means. But the independent sponsors I talk to, and just speaking from personal experience, fit is by far and away the most important thing, because if even if you get the best economics possible, 100% of zero is still nothing.
Yeah, and I'll tag on to that, because I saw in the Q&A here that there's some questions about how do you approach figuring out who the right capital partner is. And, I really think that you're going to kiss a lot of frogs. That's the nature of this business. It's the same for any side of it. You only do 1 out of every 100 deals you even see at best. But I would really recommend to any independent sponsor that's trying to find good capital partners, figure out the top 5 issues that really are critical in this industry, whether they're customer concentration, cyclicality, management succession issues, things of that nature, and really probe with that capital provider which ones are non-starters for them in their business, which ones are acceptable, how have they dealt with those in their other funded or their other portfolio companies. And as you have deals that hit certain issues or don't meet certain issues, remember that and have that kind of criteria or whatever you would call it, so you go to the right people and save yourself a lot of time. But there's a lot that's part of that first 2 years. It's not just finding the right deal, it's starting to figure out the capital partners and meeting the people in the market and what their issues are and aren't.
And just to touch on that, Peter, you talk about like the issues. My recommendation is lay everything on the table with your potential capital partner, both the positives and the negatives, because Peter and I, we spent a lot of time with each other. Multiple meetings, multiple phone calls. You can't fake it. I mean, eventually, if there's something that if there's some issue outstanding, it's gonna come about. So my recommendation is just lay everything out on the table at the beginning.
Can we talk a little bit about how you find capital providers like Gladstone? I know there's obviously the McGuireWoods conference, but what are some other resources that independent sponsors who are trying to get their first deal, or they have their second deal and they just want to go out to others and learn what's out there? Like, how do independent sponsors find capital providers?
So I've been doing it now for 5 years. I would say I have a very good stable of good capital partners who I've shown deals to and who I've known for 5 years. But looking back on it, I went to the McGuireWoods Independent Sponsor Conference. That's a great resource. I met a bunch of independent sponsors and capital providers. I probably talked to an independent sponsor, someone who is an independent sponsor, or I was thinking about becoming an independent sponsor maybe once a week. So networking with other independent sponsors. I know looking back 4 years ago now, I had a lot of independent sponsors give me advice. So it's a very, it's a very strong community. So, networking is really good. And also just asking, other capital providers, hey, if this deal isn't for you, do you have any recommendations? So it's a little bit, you got to be scrappy, but I think that there are avenues, there are resources out there, and also panels like this.
And Peter, I think, touched on it a little bit as well, but the wider acceptance of the independent sponsor community really is in my book, a true standalone segment within private equity. We've certainly seen a significant uptick in placement agents and their focus on the independent sponsor community. I think there are pluses and minuses to some of them, but that's certainly an alternative that a lot of independent sponsors are, pursuing. Oftentimes, it can be less so about truly helping me find the capital and more so about expanding my team and leveraging resources that the placement agent can bring. So that's another angle that people have been looking at.
That brings up an interesting point. One of the questions was talking about infrastructure and team. Rob, you found a CEO at 30 years of industry experience. You found someone to partner with that. I don't know how common that is with other independent sponsors, but can we talk a little bit about, are there successful models on building a team or infrastructure in the fundless model? There's an inherent challenge on timing of realizing economics and being able to keep up with the monitoring and the deal flow.
Yeah, I think, I learned, some time ago that, being the Lone Ranger, you're not going to be successful. You have to have a team, you have to have partners. So for Bassett Creek Services, our CEO right now is Dan O'Brien. We partnered with his company 6 months after the first deal we did with Peter. Then about a year later, we named him CEO. From a roles and responsibilities standpoint, there's a lot going on, and having executives, having industry experts that can play a role, that frees up my time to focus on other strategic initiatives. So, whether you're a one-person independent sponsor firm or you have a team of 10, you have to have good partners. You have to have other people around you, because the reality is that you're going to be pressed for time. Both in sourcing the deal and monitoring the portfolio company.
Barry, I'd be curious to hear kind of some of the key lessons that you wish others should know after Fund 1, Fund 2, Fund 3. I know in our vlog episode on investorsandoperators.com we went into these, but I'm curious if you could share those with us.
Yeah, I know we talked about a couple there, Jordan, but I think, first, starting off, like we've talked about today, getting a great sponsor to start with really helps a lot. We've heard about Gladstone here, great firm, very helpful to Rob. In my own case, the CIO of Capricorn, which is Jeff Skull's family office, he and I went back all the way to 7th grade together. And he pursued a career, and I was at TriVest at the time. And he said, hey, how would you feel about, doing, focusing more on a platform where we would be backing you. So that was helpful. First, having that relationship with somebody was terrific. I think then the next, as you sort of progress along, you have to try and strike the right balance between those who got you in business and the folks you want to diversify a little bit too over time with investing. And that can be difficult because in the early go, you're probably giving some concessions around fees and such and carry and you're just trying to strike that right balance. And I think a lot of the smart backers understand, there's a team that needs to be fed and a portfolio that needs to be looked after. And as that grows to do a good job, that requires a little bit more resource and dollars. So I think that's something, striking that balance between those who get you started and where you need to go to over time. And then last, I would say just sticking to your knitting. We've been oversubscribed in our funds, and I think you want to continue to focus on the opportunities that develop the track record and the success of your team along the way, and just not grow too quickly over time. And I think we've done a good job of that. I think if you look at the great funds out there that are successful, I think there's a nice pace to their growth, and they don't necessarily just grow at the rate at which the market will give them capital. So those would be three of the things that always go through my mind a little bit, Jordan.
Nice.
Very helpful to just quickly just get a sense, interesting as you made the transition into fund manager from deal, just from deals. What I find is one of the hardest, interesting, just initial leaps that managers need to make is actually going from talking about deals, the deal lingo, describing deals, to being an asset manager, why it works, what's your universe, what's your advantage in that universe. Those are two different conversations, and I find it's very hard for teams to actually get into speak that as it actually relates to limited partners who need to think about this strategy against the other different asset classes even they're looking at, and how they think about the middle market and how it fits in.
I think that's a good point, Sheryl. Look, I was fortunate enough to have great experiences and learnings in that area with First Trivest as a very successful middle market fund, and then second with a hedge fund in Silver Point Capital. And for another day, I could share the benefits, I think, of being sort of in a private equity firm and a hedge fund. How I think there's a lot of benefits to those two as well, because certainly in the hedge funds, you think a lot more about portfolio construction, which I think is helpful. So I was probably lucky enough to see funds and how they were run and be part of those at a fairly senior level before launching into the next chapter. So it was almost like fund world, a little bit deal by deal, and then launching another fund. And I think that was helpful to do that. The last comment I would make to your point, Sheryl, is we too have done some independent sponsor transactions where we've backed former CEOs who've had no experience in the investing world. And those are interesting ones, right? Because they find great deals typically. They can sell very well and say, look, I've been there and done that, and get good deals. But their knowledge of the fund world is very small, like you say, right? And maybe that's not such a bad thing. But in those situations, that's where we've tried to play a role a little bit with those independent sponsors and say, look, we can help you with that aspect of things. If you are thinking about becoming a fund, work with us, because we've done that, and we can make introductions. We can help you think about building a fund, the pros and the cons of what that looks like. Because it is it's a different business, right? It's a different business, and some choose to go the fund route and some don't. In fact, I just got off a call where the fellow was in a fund, and he's now going the fundless route for a lot of the reasons we talked about here. So hopefully that answers your question, Sheryl.
And so one of the questions from an attendee is for Peter, is Gladstone typically providing most of the equity in a given deal? And if so, is it often the form preferred? What about additional debt providers in a given deal alongside Gladstone?
So on the equity side, yes. I mean, obviously seller rollover, Equity invested by the independent sponsor directly or fee rollover is a big part of it as well. And we're always open to having other parties in the deal but again, it kind of goes back to what value are they bringing to the table? If you have an industry executive that wants to be on the board and can really add value, of course, who wouldn't want them investing in the deal alongside you? Usually isn't preferred, but at this point, going back to independent sponsor economics, 5 years ago, any independent sponsor, investment would usually go in subordinate, as would sell a rollover. Now everything's pretty much pari passu except for the incentive equity pool. That's kind of become market. Same way that catch up on all your carried interests has become market, as of where it wasn't 5 years ago. And then on the debt side, what we do is we provide a unitranche slug of debt effectively, but we always look to bring in a more traditional line of credit from a traditional lender or bank post-close, but we bridge the deal with an interim line of credit to kind of handle the first 6 months post-closing.
Great. Next one is, does the panel have any comments on dead deal costs and associated risks for independent sponsors, and how's this handled?
I was
John?
hoping you weren't going to answer that one, Jordan.
Just don't have any dead deals. Just make it work.
Yeah, and look, I think different capital partners, right, have their own different perspectives. I guess my take on this would be back to it's all about relationships, right? So for the independent sponsor, I would make sure that your CPA firm, your legal firm, they're truly your partner on deals. And so if they have that mindset and they're willing to share the pain, as I like to describe it, that'll get you a long way there. And then, Peter or Barry, feel free to kind of weigh in on how you guys view that world.
Yeah. I'll tell you that's part of our secret sauce about pitching to independent sponsors, to be honest. There's obviously the three legs of kind of fees: closing fees, carried interest, management fees. And there's always some game of whack-a-mole of kind of how you balance each of those three buckets in any deal, depending on what the independent sponsor's needs are. Obviously with a first deal, closing fees and management fees are probably somewhat more important than carried interest in some ways, because you want to get paid because you've been on the sidelines for 2 years. The fourth thing that we really provide is the second that we sign an LOI with the independent sponsor, we're responsible for 100% of the broken deal costs, because that's how committed we are when we sign an LOI. It's something that we take very seriously, and as a result, we're going to take it seriously from an economic perspective as well. So that's a little bit of our pitch when we go to independent sponsors too.
Yeah, Peter, I would just say that's pretty consistent. If you get to the LOI stage, we're going to be bearing the risk of that like any other transaction. I would just add, one of the things that we try to do as a healthcare only fund, if the independent sponsor is in a competitive situation and it's a healthcare transaction, that certainly is a plus. So very early on, trying to be helpful to the independent sponsors, weighing through something like healthcare IT, the specialization can be a plus, beyond the dollars.
Yeah, Barry, one question I'll ask you, because I saw it in the Q&A, and I'm sure Jordan will get to it, is, when do you guys like to be brought into a deal? Obviously, we always want to be brought in as early as possible. What's your experience been? And I could chime in with my own afterwards.
Yeah, early as possible, right, is the answer, and give some feedback. So that's kind of that way we can help make folks a decision of this one's for us or not for us, or hey, you ought to think about this group or that group. Maybe they could be helpful. So I can't think of a situation where it's been too early.
Yeah, that's kind of my feeling as well. And I know I feel like that's changed a lot over the last few years as well, is that more of the time the independent sponsors probably finishing a QOV, if not far along with one before we're even getting introduced. And, I think it's important to try to involve your capital provider as much as humanly possible. I know with the time between LOI to close is shortening with time, so that makes that harder, but makes it even more important to maybe figure out who your capital partner is even before you're signing that LOI with the company that you're trying to acquire. Because I think there's valuable input can be provided. And not only that, I'm sure everybody on this phone call is seeing how hard it is to find diligence providers right at this exact moment. Maybe there's someone that your capital partner or vice versa can bring to the table that could expedite things. I
think that's right. And look, if I'm in the seat of an independent sponsor, there's probably a balance of, there's a weight, how much interest do I have in this transaction versus spending all the time and energy and running it all the way down the field to a point of, of having the nice, pretty book analysis QV and fully baked, right? You know, that's, do you go broad with a number of opportunities or narrow on one or two and kind of put your chips there? So I'm sure some folks that we work with and look at deals from, you can see how they vary in the approach that they take, you know, of not having anything at all versus a fully baked opportunity.
Peter, Barry, you guys hit on it for sure, that has evolved in the, you know, when you get it under letter, come talk to me versus what you're saying. I'd love, Sheryl, Barry, Peter, what do you see as some of the next evolution, if you will, within the independent sponsor community? How do you see the horizon and other changes that we may see?
Well, I'll give just my 2 cents. I actually don't think the independent sponsor community is going to change too much. I think they're going to take on more and more of that burden like a traditional fund. And there's going to be capital providers that pivot to become more of a really servicing the independent sponsors exclusively, that they really are better streamlined so that they can make quick decisions, review, you know, more like a fund of funds kind of view, that you're just taking a lot of finished product and you're giving a yay or nay and you're in or you're out, and these are the legal docs and you might be able to make a few changes. But I think the capital side is probably what's going to change more to fit the independent sponsor community because it is growing so rapidly.
I've actually seen a real evolution though in the information availability and the comparisons. And so just as, you know, we actually just cover funds, but the in terms of just watching the independent sponsor community, the ability to make those relationships are much greater than they were even 5 years ago, just with you know, just the availability of technology and getting deals done and signed, and the speed is getting faster. The one thing I will say though is, you know, there are discrete check sizes. And so you really want to watch out as an independent sponsor when the needle is moving in your marketplace, because family offices or Gladstone's will have a certain check size that they're accustomed to. And if you need to move, if your market or your expertise is in an area that's moving a different check size, you need to find out whether maybe that's the family offices, or it's, you know, larger, or it's endowments and foundations, or maybe it's getting into the pension side. You know, so there's discrete check sizes in the capital provider community that you just need to know where you are, and maybe if your puck is moving around, and that's could be a reason to change your structure.
Yeah, Sheryl, I think that's right. Discrete check sizes, and then I think even the next potential evolution off of that, at least from what we see, is just sector and subsector specialization. You know, just like in the private equity world, you know, 10, 20 years ago, a lot of generalists increased specialization. Starting to see that even more on the independent sponsor side as well, at least from our standpoint, from some pretty very focused PhD life sciences working on X, and we maybe just didn't really see that before.
Mm-hmm. So just to completely contrast, to really put a pin in what Barry just said, and also just contrast what our universe we're talking about with, you know, the sort of mid to large buyout fund that's a generalist, and they are really facing a much slower capital growth than sector specialist funds. So I put that dividing line that you typically have more sectors specialist funds under about 1.5 billion fund size, and more generalist buyouts, just by size of the funds and requirement to, and smaller universe over about 1.5 billion. And the 1.5 billion, Bain just put out a report that over 1.5 billion, they're growing about 10% capital growth, a little bit less over the last decade. And sector specialist funds are growing at about 15% rate in the last 10 years. So have grown. And so there's really has been a focus where, you know, the specialists are sort of chipping away at the generalists. And so I think we'll continue to see that evolve. And so, yes, there's a lot of room for sector specialists, even, you know, whether it's a deal point where it's creating a special strategic partnership with you and the target, or it's just in a fund wrapper.
Hey, John, I wanted to touch back on something just that John said earlier, you know, that more and more independent sponsors are trying to get diligence done before really going to capital partners. John, do you think that's a perception issue on the independent sponsors part, that they should have a more buttoned up package to provide, and that's why they're doing it? Or is there just a time constraint? Well, what's your perception on the reason for why that's happening?
Yeah, I think it's partially a time constraint. I also think that, ultimately a lot of what goes into that dating and selection, I think it's arming the independent sponsor, really wanting to be armed with the answers that you and Barry and others are going to be asking them. So I do think while the capital partners aren't as, quick to say, come to me when you have this buttoned up, I think the independent sponsors realize the more I can get done a bit earlier, maybe before we're involved in full-on negotiations, I think it does often come back to bandwidth. And I definitely see it both on the financial as well as the legal side, really trying to get that buttoned up earlier.
Yeah, and just to give my sense as a capital provider, that actually is probably more frustrating to us than helpful, I'd argue, because I think if bandwidth is an issue, that's something that we can help with. And we're not looking for a solution to every problem. But to Rob's point earlier about making sure all your cards are on the table, identifying the problem so that we can all go hand in hand and go figure it out together. That's all we really want to go do. It's not, we don't need everything pretty and tied up with a bow.
Well, guys, I'll give the last word to Rob, the independent sponsor on the panel here.
Well, I could talk for a couple more hours. I think it's been a great conversation, and I'm really curious to see how the independent sponsor community evolves over the next couple of years. So great discussion.
All right. Well, if you have any further questions or comments, please feel free to email us or reach out, and then we will get this, put it into a full video and recording and an article and distribute it by email and LinkedIn. Everyone, thank you so much for your time, and look forward to hopefully a part 2 sometime soon.